Hey guys, Chris Haddon, Jason Balin here with the Private Lenders Podcast, sponsored by our online platform for hard money and private money lenders, hardmoneymastermind.com, and our lending company, hardmoneybankers.com. So we are going to jump in with an update. It is the end of May, and we are coming towards hopefully the tail end of this pandemic lockdown that's been going on about 8 weeks now. I was taking a look at my calendar, and I've actually been making notes of like stuff, just because it's hard to remember what I don't know if you agree with this. It's hard to remember what happens during this blur of a quarantine. And so I've been making notes of like, on this date this happened, on this date this happened, and I saw that if you remember the last time we were in the office as a team, because right now we've been doing one per day as a team, it was the 25th of March, so just over 8 weeks ago, because it was when we did that big online meetup.
That's right.
That was the last time that we were both in the office, and we had a couple other team members there too. So that was the 25th of March. It's been a little over 8 weeks. A lot of stuff has happened. So we're not going to do a full recap because we've been pretty consistent with putting out our podcasts and our videos and our emails about everything that we're seeing in the real estate and hard money world. But we do want to do an update of what we're seeing now. And we got a few things to talk about. So in a lot of the country, they've been easing the restrictions on businesses, and not necessarily social distancing, but kind of. I mean, obviously people are still need to wear masks in public and stay away from other people and the 6-foot thing and all that. But things are starting to open up, specifically related to our industry. It's been getting, so in a lot of our jurisdictions, construction has never stopped and real estate sales have never stopped. But in some places they did, right? Like they weren't allowed to put on new listings, and I think that's been relaxed. I feel like settlements have been occurring all the way through in our jurisdictions, even if it's been a little, clunky to close these deals up. But yeah, I mean, what do you think right now? Like, what are you seeing right now in terms of how things are functioning, the real estate market itself, like all of that that's happening?
Well, so I think the real estate market never really stopped, especially for real estate investors. Now, yes, there was hiccups. Yes, there was slow. Yes, permitting offices had issues. In Philadelphia, there was issues with some construction and things like that. You had to have less people there. But in general, people wanted to invest in real estate. I think the bigger issue was the consumer confidence related to it as a whole, not necessarily the small niche community, but the larger real estate community as a whole. And it's weird because this kind of had like the opposite effect, what I think people would have thought. Like in the DC area and the Baltimore area and the Philadelphia area, markets that we cover, it's almost like it feels like we might have some sort of like boom or like real estate boom coming up soon. It's kind of a seller's market, right? Unless sellers had a need to sell, they weren't selling. So any property that is on the market that's fairly priced has been selling, if not selling above market value. It's crazy. And that's just supply and demand. So from speaking to real estate agents, from talking to a lot of other investors, experts ourselves, and just doing research and what we see out there, at least locally, that just seems what could potentially happen, which we thought could be the complete opposite of what was going to happen. And we'll get in a little bit deeper in a second related to what we see out there from looking at 1,000 new inquiries every month and talking to a lot of investors and kind of just get gut feels. Because the cool part is when you have access to a lot of deal volume. I was telling one of our private lenders this the other day, like we create our own internal algorithm of what we believe we're seeing in the market just based on data that we get from people, that we talk to.
Good point.
And we'll get to that in a second. But I think as consumer confidence opens up and sellers are willing to let buyers in their house, buyers are willing to go into houses. I think things, who knows? It's the weirdest thing. Like, who would have thought there could be like some sort of real estate boom? But like, I kind of believe, and I think interest rates have even kind of been going lower since this happened. Mortgage interest rates. So it's kind of weird.
It is interesting, and I don't remember the last time we saw. I'd have to think back a little bit, but yeah, the reason why we're seeing prices being stable is a decrease in both supply and demand, right? So like there are fewer houses to buy, and there are fewer buyers out there, but they kind of match up, right? If anything, we see some more buyers out there than we see sellers. So like less inventory. We haven't seen prices being stable because of decreasing supply and demand in a while. I mean, that usually it's the opposite. It's the opposite. Like everyone wants to sell.
At least around here. At least around here, yeah.
At least around here in DC, Maryland, Virginia, our main market. So yeah, that's an interesting thing, and that's a good point too. And I've had similar conversations with some of our investors about how we keep our pulse, just like you were saying, how we keep our pulse on the market based on our own company and everything we're seeing. So like everything on the front end in terms of new inquiries and what our clients are saying about acquisitions, to what's going on with construction and payments and everything in the portfolio and sales. Like we're getting loan payoffs because properties are selling or refinancing. Yep. Either one of those is a good thing. So we do get kind of a good snapshot on at least our local market based on our own company. That is.
Yep. Yeah, I agree. I 100% agree on that. And it was interesting, like right after this happened. And again, you can always determine your metrics if you get enough lead flow. And our whole business model is marketing. And if you've been following us for long enough, it's just all about having the right deals, like just having tons and tons and tons and tons of deals to choose from. And you're in a good spot if that happens. And because we get tons of deals, we get to look at a lot of different opportunities. And right when this happened, so like mid-March, I remember we were like, we're not sure exactly how to quote some of where we want to be at. There's obviously the right number. We were at like 65%. We lowered to like 50%. And that was kind of our quotes. We went out there at 50% of the after repair value and, close to 50% of the as is value, maybe a little bit higher than that for the most part, but similar to that. And all the newer investors, all the hobbyists kind of disappeared. They were unsure. They didn't know what was up. They kind of disappeared. And a lot of the good investors were still in the game. And some of them could make those numbers work. A lot of them couldn't. So we kind of started from that, and we've raised a little bit more. But since then, we've been doing some deals at 55%. We've done deals of 60% if it's the right person. The quality of borrower and executor has definitely been important. You want somebody who can definitely who's strong and can qualify and have other means to get capital if they need to. So that's an important part. But the interesting thing is this. If you go out and you quote all your loans at 50%, you can't get any deals. That means chances are you're not lending aggressive enough. You're probably just too conservative. And on the other side, if you go out there and you're at 65 or 70 or 75% of the after repair value, you get tons and tons of deals. You're too aggressive. So you can create that algorithm the way you want. And Chris and I were talking about that earlier, that time will just tell, and supply and demand and communicating with a lot of people will determine where we need to come in at. Like it's that simple. Now, the interesting thing about people that we've been chatting with is everyone is so used to the institutional back capital. The terms that they use now are very different than the terms they used back in the day. Back in the day, it's like, hey, the question would be like, cool, like, what are your lending criteria? It's like, oh, we'll lend up to 65% of the after repair value minus construction costs, or 60%, whatever it is.
It's like ARV based.
ARV based.
What do you go up to 65? You go up to 70?
They don't even know what that is. Now they just think it's cost based off purchase price. They're saying, hey, do you do a 90-10 or an 80-20? I'm like, what? Like, do you lend 90% of the acquisition, 100% of the construction, or 80% of the acquisition and 100% of the construction? I'm like, yeah, we don't really structure it like that. And I know what they mean, and I kind of play dumb a little bit, but I understand it. And I'm like, yeah, it's, listen, if you buy a really, really good deal, you're going to need less, a smaller amount of cash. If you buy a really, really bad deal, you're going to need a lot more cash. And I usually just say kind of industry average, like, yeah, you're going to need probably 30% plus cost, give or take. So they're like, oh, cool. So you do like a 70-30. And I'm like, that's just where it ends up coming in at. But I've been trying to go back and forth. See, the hardest part is to determine, before you quote, because before it was kind of an easier quote because everything kind of fell more, kind of more, evenly. Right now, I really got to determine how strong the borrower is to determine, because again, if I have a really, really good borrower who I know is going to buy a really good deal, and I tell them we're going to be at 70% LTV based off the purchase price plus cost, they might get a little bit nervous on it. But then again, I'm not going to tell somebody who doesn't know what the hell they're doing that we're going to give them 80% plus construction costs either, because that's going to be a lie. It's going to be lower than that. So I really got to get some more information now than before, based on their experience, based on their cash, to see where it's at. And I try not to quote you know, estimates until I kind of get that. And again, like it's kind of weird, but you know, typically your percentages on slightly higher price points might be a little bit more favorable for them than on lower price points, right? Like we're not doing, if someone's got 30 grand, like there's just not a deal to be had, right? There's just not enough cash into the deal. So
right.
there's a few more variables right now. And, you know, just like everything, like if, you know, you always got to wear your sales hat and your underwriter hat at the same time when you're talking to somebody, because you want to be salesy to try to get them to, you know, get the deal to you, but you got to be cautious and, you know, wear your risk hat and your underwriter hat. So I'm trying to do that the same way. And I definitely think I pushed some good borrowers away because I was a little bit more cautious. So as of the last few weeks, and again, this is just supply and demand with our pipeline, right? You know, pipeline had a lot of really good deals. Then some of the pipeline had maybe some less qualified deals, but you know, so like you just go back and forth to figure out kind of where the metric is, and the metric's changing, especially as some of these institutional lenders are in the market, out of the market, coming back in the market. We'll talk about that in a second. What we see out there.
Yeah, coming back in more conservative ways and all that. Oh, and I was gonna tell you, I think I mentioned this a while back, and I've been doing it again recently just because it's kind of fun to me. So I followed the hashtag on Instagram, Hard Money Lender. Yep. And so I'll see the posts of a bunch of hard money lenders, a bunch of lending companies who I don't follow otherwise because they use the hashtag, in case people aren't super familiar with how that works. And so I'll oftentimes see posts that are using the term clear to close, or like no conditions or stipulations or anything like that. And guys, like those are bank lending terms or institutional lending terms that we know well because we were in the regular mortgage business before we started HMB many years ago, early, mid, like late 2000s, around there. And that's when we heard those terms. And the fact that hard money companies are doing social media posts using clear to close as like a meme or something like that is really funny for us, and like what we've seen along the way. So I can't help but comment and troll them a little bit and be like, clear to close. What the hell does that have to do with a hard money loan? And then they'll be like, well, it's not only a hard money term, it's actually a lending term in general. I'm like, all right, whatever. I probably shouldn't troll them to begin with, but it's entertaining to me. So I do it here and there. And those people will shake out in time. But anyway, yeah, speaking of those, it's going to be interesting to see what happens with a lot of the people that 8 weeks, 10 weeks, something like that, funding disappeared. Some people stayed in the game based on their funding source, and we're talking institutional people. Obviously, private capital people have stayed in play. And then some people did not. Some people disappeared and were like, we're on pause. We're going to come back later. And we're like, wow, I wonder if they aren't. And it looks like they probably will roll out some more conservative lending programs and get back in the game. And we know that they're quoting some deals now. That doesn't mean to say that they're actually closing, because you never know until that wire hits. It's just, you know, writing on paper. That'll be interesting to see what shakes out. But no, it's been an interesting ride, this whole pandemic situation and quarantine. And I was thinking recently this week about just everyone's sentiment around it. So 8 weeks ago, people were really scared just of the uncertainty, like of the whole thing. Obviously, we're not going to dive into like, you know, epidemiology and stuff like that. That's not what we do. But like, just whether, like, how scared should you be going out in public with a mask? Like, or do you do or you don't? Like, that was very different 8 weeks ago. And people, and also business-wise, what's going to happen with the market? Everything's staying okay. The stock market's bounced back. The real estate market's alive. And then I've noticed it in the past week or so that I've been thinking about it. People's sentiment around everything going on has really changed for the positive. And I don't know if that's going to end up being, it might be a little premature. Like, people are getting a little too excited. We saw about everything that was going on with Memorial Day and people getting a little too aggressive with their parties and like large gatherings and stuff like that. So I don't know. There's no way for us to predict, not our expertise about, you know, how much you open up and when and all of that. But I'm just saying that I've noticed that sentiment that people have like changed, like in a pretty crazy way compared to 4 weeks ago, compared to 8 weeks ago.
Yeah. And I agree. And kind of relaying that back to real estate, like early on, 60 days ago, all the newer investors and the hobbyists, like they heard that all the capital was out of the market with the institutional capital. They, typically when the hobbyists and the newer investors are in, I mean, there's always newer investors, and that's a good thing. Don't get me wrong, but like they always say that, what's the quote? When you see everybody, when everybody's buying informational products and all the gurus are out, the market's at the top and the market's just not good. And that's the easiest time because everyone wants to jump into the market, right? So and all the hobbyists have been in the market, and the newer real estate investors have all been in the market over the last 5 years. And then because everything's like, oh, real estate's great, real estate's hot, so everyone wants to jump in, and the gurus have products to sell. And the other side, when you can't sell any products online because real estate sucks, that's the time to get in on real estate. And what I've noticed is a lot of the newer investors, I had a lot of qualified people, really qualified people reaching out to me early on, and a lot of them couldn't make the deals work because everyone's used to institutional money. Like it's tough when you're used to getting 8% or 8-1 or 8-2, and then you go to somebody at 13-3. It's not that they don't respect the loan product, but it's more of like they just didn't have that kind of budgeted, or they just don't have that ready to go, or they're just not. I actually think it's more mental because than anything else. And I get it. It's like, yeah, I'm just not mentally prepared for that yet, because if you do the math at 8-2 compared to 13-3 for a short-term loan, a few month loan, it's really not all that much more expensive. It's a few $1,000, for every $100,000. So it's like, yeah, so it's sticker shock. But I've noticed like lately, all the newer investors are back out. They're all back. And again, and I'm not stating that we don't do loans for newer investors, because we do, if they're qualified. And what I mean by qualified, might not have experience, but they're qualified. They have good cash flow. They have real assets. They're successful in their current line of work, things like that. And they'll be successful as a real estate investor. But, in general, they're coming back and be like, yeah, I'm looking for 100% financing, or I'm just trying to get into real estate, figure out how it works. Like I've just noticed a lot of them have kind of come back into the space, and I have to pre-qualify for them because they think real estate's back. Like they thought, oh yeah, it was kind of a little, speed bump, and now everything's back. Like it's almost like it's back to how it was 60 days ago, in general. Now it's not fully like that for a few reasons. Number one, the institutional back lenders will not do their requirements are higher. They're typically coming in at 80% of the purchase and 100% of the construction, and you need like a 650 or higher credit score, right? So a lot of the newer investors just are, that don't have much cash, like that's out. They're not gonna be able to do that, right? When they normally could. Before it was lower credit requirements and a 90%. So they were able to do that. So that stopped. But at the same time, a lot of the bigger investors that were well capitalized, not the bigger, dumber investors. And what I mean by that were the ones that are just doing tons and tons of deals because they had to. They just had a big machine, but really on paper, they just didn't have any money. They were just doing tons and tons of deals, and they don't even know what their numbers look like. But the bigger real investors, a lot of them are sidelined. They're trying to find the best of the best deals, and there's not that many of the best deals. There's just not a ton of good deals. So a lot of them are somewhat sidelined. And like we talked about a month and a half ago, when we had a conversation, the newer investors are picking up the deals that the older investors used to be doing, but now they're sidelined because there's not enough margin. So they're picking up them. Then you have somebody who can't execute real well. So we'll see what happens. I mean, the good news for private lenders and hard money lenders, this is the best part about this business model in general. Every deal you lend on is its own individual asset, and it's treated like its own individual asset. So today we write a loan for $100,000. Tomorrow we say, you know what? I think I'm comfortable lending 110,000, right? And we lend 110,000, and maybe we lend 120,000, and then potentially something happens, interest rate rise. We say, you know what? I think I want to lend 90,000, right? So you do that, and you underwrite each individual deal like its own, and not as a whole, right? As its own, and in general, it works. And guess what? If something drastic happens, where the market really interest rates go up, nobody can get out of these deals. There's going to be a small portion of your portfolio that does fail, but you also have your portfolio that succeeds, and hopefully that carries the weight of your smaller end portfolio. So I love being involved in the business model because of that. And I'll tell you, we'll probably get a little bit more aggressive, maybe, coming into the summer on collateral with some of these deals, raise it from 50 to 55 and see what happens. But again, one thing that we've really been strict about, and I believe all private lenders should be, is the quality of the borrower. Make sure you have, and that's always the fact on any deal, like make sure the borrower can perform and it's a good quality part. You have a good quality borrower, and then you have unbelievable collateral as the backstop. and then it's good.
And then so touching on that real quick. So if anybody listening or watching on video is lending money or wants to scale, whatever it may be, don't totally get sucked into what a lot of the capital out there is requiring, just like an X amount of down payment. Like, you need to know the value of the asset you're lending on. That is the business. It was the business a few years ago. It was the business many years ago. It's still the business now, and it will be in the future. Right. Know the value of the asset you're lending on. And if you don't, if you're relying on an appraiser 3 states away, or maybe just who cares, it's a down payment, you're going to get in trouble. You're going to get in trouble at some point. And if you want to stay in the game, know your assets. And you'll notice that the good lenders do. The real lenders do.
Yeah, that's right. That's right. Cash is king. Cash is king on some of these deals. Yeah, I mean, listen, there's nothing wrong with getting aggressive on some deals and being more conservative on other deals. You're the lender. You make the rules. You underwrite them. You determine what works or doesn't work. I mean, we were talking today on a particular deal that's a little bit of a larger project in general, just because it's in a really good area. I mean, in the 500,000, it's not the multi-million dollars, but like, on the higher end spectrum where we lend. And, as a percentage, the numbers aren't great, but on how much skin in the game the guy has, it's wonderful, right? I mean, keep in mind, somebody puts down 20% on a $500,000 deal, that's $100,000. If you put 20% on a $100,000 deal, it's $20,000, right? Like, it's just not enough skin. It's just not, it doesn't work. And that's kind of hard to explain. All of us, well, not Chris and not myself, but most people in this industry are trained to look at this thing as like, oh, an LTV, or what's your LTV, or what's this? And it's, let's see if the thing makes sense, right? Like, I understand that, percentage wise, it still equals the same, but let's be honest. Think about it like this. If you have a 35% equity cushion on a $100,000 loan, right? That's $35,000. If you have a 35% equity cushion on whatever, a $500,000 loan, that's $175,000 in cushion, right? That's a lot more cushion. Percentage wise, it's the same, but dollar wise, it's not. If you do a $100,000 loan,
in reality, and from experience in reality, it's not the same.
Yeah. If you do a $65,000 loan on a $100,000 asset and it defaults, you will lose money. It's that simple. You will, if it really defaults, and if you're in a state that foreclosure takes a long period of time, you're going to run into problems. So, if you're doing deals in that price point, you either got to lower your exposure, or you really got to make sure your borrower is locked tight and it's the right borrower who is going to perform at all costs. Because if that deal starts going sideways, you just are like, legal cost, foreclosure costs, filing judgments, back interest, covering property taxes, covering insurance, being countersued, whatever it is, it's real stuff. It's real stuff, and it's real money, and it's hard to recoup. And so that's a different rant for a different conversation.
All good. Yeah. So we just wanted to check in, guys, and let you know what we were seeing here at the end of May, after 8+ weeks of pandemic quarantine and all of that. And there's some positives out there, some negatives, obviously, in a difficult situation like this. But yeah, we'll continue to tell you exactly what we are seeing and hearing, and hopefully we all get through this together.
Yep. Hi guys, thanks for tuning in, and we'll see everybody next week.